Hey, one of the questions that I get asked often by our clients when they're sending their financial projections to their SBA lender, they want to know what's the SBA lender going to do with these projections once I send them to them? How much are they going to beat up on them? What's the underwriter going to be looking at my projections, and how are they going to respond to them? And so I thought I'd record a quick video just to kind of hit on that key question. So before I dive into that, I guess just a little bit of background. My name's Adam Huxama. I'm the co-founder of ProjectionHub, and we help people create financial projections for SBA loans and for potential investors. And before working at ProjectionHub, or before I started ProjectionHub, I was the executive director of an SBA lender for 12 years. We made over 1,500 SBA loans during my time there, and so based on that background, I'm kind of coming to this work of the projection side of things and trying to help guide you as you're working on projections for an SBA lender. So I've got an example financial projection pulled up here, and I'm going to walk you through kind of what I think an underwriter is going to be looking at and what they're going to be doing. And that will help inform you as you're thinking about how to set up your model. So, okay, so I've got, this is our acquisition projection template. And I'll put a link to the acquisition projection template in the description of the video below in case you want to take a look at that. We have a number of different templates. We have about 125 different industry-specific templates, so you can kind of have your pick there of a template that would be a good fit for your specific scenario, but they're all going to have this kind of profit and loss at a glance. So I think the underwriter is going to, take a look at this. One of the key things they're going to look at is this debt service coverage ratio. And so debt service coverage ratio just means how much profit or cash flow do you have to be able to cover your debt service or your loan payment. So if this says 1.31, that means I have $1.31 for every dollar of loan payments or debt service. And typically, an SBA lender is probably going to want that to be 1.25 or higher at the very least. But, you're providing your version of the projections, right? And the lender is going to look at it and say, well, let me beat up on this a little bit. Let me change some of the assumptions. And then they're probably going to look, okay, if I change assumptions, how does that debt service coverage ratio look? So what I would expect a lender to do, first thing, they probably look at your revenue. And in our example here, we've got, our projected revenue. So we've got like our historical revenue for this business that we're acquiring from the prior fiscal year, and then we are applying a 5% annual growth rate. Now, I think first thing lenders going to do is say, what if they don't grow at all? What if there's what if there's no growth for the first couple of years? Or maybe just in the first year, How does that look? So change that to 0% growth. Where's that bring our debt service coverage ratio? Well, now we're below the 1.25, so we're at 1.21. Next thing I imagine lender's going to do, you're going to look at your expenses. And you're going to say, okay, what we typically do here is we'll set the expenses as a percentage of revenue. And so we'll look at historically. Here was what those different expense line items were as a percentage of revenue. So you can see, here's the different expense line items. Historically, this is the dollar amount and then the percentage of revenue for those expense line items. And, it might make sense from your projection standpoint. You say, hey, we're just going to keep these expenses the same as a percentage of revenue as they were historically. Now, if you are getting aggressive and say, we're going to cut expenses, expect the lender to look at that and say, no, we're going to set them back to the way they were. We're not going to allow you to cut those expenses. So here's an example where we said, hey, we think we can get cost of goods sold from 32.76% down to 30%. We can get that under control here. Well, underwriter's going to say, no, we're going back to the 32.76% that we were historically. How's that look now? Now our debt service coverage ratio is 1-to-1. So this is the type of thing you can expect an underwriter to do is kind of beat up on the numbers a little bit and then look how that impacts cash flow. And what they want to be able to see and be able to do is, they're not going to be excited about a deal that, based on your maybe aggressive projections, just barely pencils or just barely cash flows. So I would go in expecting them to beat up on your assumptions and really stress test them and see if the deal can still make sense. So that's what I think you should expect as you're submitting your projections to your SBA lender. If you have any questions or need help with your projections, feel free to reach out to us at support@ProjectionHub.com. We can help with that. And if you thought this video was helpful in any way, it'd be great if you could give us a thumbs up and subscribe to the channel, as we're trying to share more information with people that are looking to get SBA loans. So happy to answer any questions that you might have. Thanks.